In this video, we're going to be performing a deep dive on Leggett Platt's dividend safety. To begin, let's talk about Leggett Platt's business model. Leggett Platt is an engineered products manufacturer. The company's products include furniture, bedding components, store fixtures, die castings, and industrial products. Leggett Platt has 14 business units, 22,000 employees, and 130 manufacturing facilities across 18 countries. Leggett Platt was founded in 1883, is headquartered in Carthage, Missouri, and is currently valued at $4.7 billion. Leggett Platt is a well-known dividend stock because of its compelling track record of dividend growth. With 47 years of consecutive dividend increases, Leggett Platt is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. Looking ahead, Leggett Platt's high dividend yield has led many investors to question the safety of its future dividend payments. For the remainder of this video, we will discuss the company's current dividend safety from 4 perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Leggett Platt's dividend safety in the context of the company's current earnings. When Leggett Platt reported third quarter financial results on October 25th, the company announced that it generated earnings per share of 67 cents in the 3-month reporting period. For context, Leggett Platt currently pays a quarterly dividend of 38 cents per share, for a payout ratio of 57% in the most recent quarter. Using earnings, Leggett Platt's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. With that in mind, we will now compare Leggett Platt's current dividend payment to its free cash flow. In the third quarter of fiscal 2018, Leggett Platt generated $126.5 million of net cash from operating activities and spent $41.4 million on capital expenditures for free cash flow of $85.1 million. The company spent $49.4 million on common share dividends during the same time period, for a free cash flow dividend payout ratio of 58%. Looking out over a longer time horizon can often be useful when assessing a company's dividend safety using free cash flow due to the sometimes erratic timing of capital expenditures. Leggett Platt generated $251.1 million of net cash from operating activities through the first 9 months of fiscal 2018 and spent $122.6 million on capital expenditures for free cash flow of $128.5 million. The company spent $144.2 million on common share dividends during the same time period, for a free cash flow dividend payout ratio above 100%. On the surface, this might be alarming. However, Leggett Platt's inability to cover its year-to-date dividends using free cash flow is due to a significant one-time $122 million increase in working capital. If we back out this charge, the company's free cash flow dividend payout ratio declines to a much more reasonable 59%. After making this adjustment, we come to the same conclusion using free cash flow as we did when using earnings to measure Leggett Platt's dividend safety. The company's dividend appears safe for the foreseeable future, and its payout ratio using free cash flow is actually lower than the earnings per share equivalent. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze Leggett Platt's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Leggett Platt's performance during this time period is shown here. Leggett Platt's earnings per share fell off a cliff during the last recession. Importantly, its dividend did not cover its earnings during fiscal 2007. With that in mind, investors should closely monitor this company's performance during any future contractions in the economy. The last angle that we will use to assess Leggett Platt's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before its free cash flow will no longer cover its dividend payment. Through the first 9 months of fiscal 2018, Leggett Platt generated $43.5 million of interest expense and had $1.357 billion of debt outstanding for a weighted average interest rate of 4.3%. The following image shows how changes to Leggett Platt's weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, Leggett Platt's weighted average interest rate would need to rise to approximately the 15% level before its dividend would no longer be covered by free cash flow. With that in mind, We believe that Leggett Platt's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Leggett Platt's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.